Okay, let's unpack this. Imagine starting with just a simple hot dog cart, right? In New York's Madison Square Park. And then, boom, 20 years later, you're this global phenomenon. That's basically the story of Shake Shack, a brand that really kind of pioneered and I think defined fine casual dining. Today, we're doing a deep dive into Shake Shack's latest annual report. And you might be wondering, how does a company with this unique, almost cult-like beginning manage all this rapid growth? How do they keep that distinct brand identity alive, and what are their plans, their big plans for the future? Especially now, the market's so competitive. Our mission here is really just to pull out the most important nuggets, the key insights, so you walk away really understanding what's going on.
Yeah, and what's really fascinating, I think, is that their expansion isn't just, opening more doors. It's tied to this very deliberate strategy. They call it enlightened hospitality, and it seems to underpin pretty much everything they do, from operations to how they scale the brand across different continents. So we'll look at how they're balancing those core values, that premium quality feel, with some pretty aggressive business goals, and of course, what the numbers actually tell us about whether they're pulling it off successfully.
Okay, so let's kick things off with just the journey itself and the scale they're at now. From that one hot dog cart back in 2004, they've blown up to over 575 shacks in more than 20 countries. I mean, that's just an incredible leap in 2 decades.
It absolutely is. A huge leap. In 2024, it was another year of really robust expansion. Their system-wide Shack count grew, get this, 11.8% year over year. Pretty impressive. So that translates to opening 76 new Shacks globally. And what's really notable is that 43 of those were company-operated. That's actually their largest class ever for new company-owned spots. They also added 33 new licensed Shacks, pushing into some exciting new places like Canada, Israel, Malaysia. But this kind of rapid growth, it does raise a big question, doesn't it? How do you achieve that scale without, watering down the brand, that premium feel they've worked so hard to build?
Exactly, and that's where their strategic priorities really seem to come into focus.
Yeah.
We've seen their goal. It's incredibly ambitious to get to at least 1,500 company-operated Shacks just in the U.S. I mean, that's more than 4 times their current domestic footprint. So what's the playbook? How do they plan to get there while staying, Shake Shack?
Well, a big piece of that puzzle seems to be building a robust pipeline for new spots. It sounds like it's very data-driven. They're not just throwing darts at a map. They're using analytics, it seems, to find these high-potential markets where they can build critical mass and really maximize brand awareness. And they're also working directly with local real estate brokers. That probably lets them move quicker, be more agile in picking sites rather than doing it all in-house.
Right, makes sense. And it's not just where they build, it's also how. Their multi-format strategy seems pretty smart. They're optimizing drive thrust. They've got 42 now, which is quite a few.
Yeah.
And refining these linear kitchen designs, clearly for efficiency. What really jumped out at me is the standardization of production models. And this focus on efficiency, it looks like it's actually paying off. In 2024, they cut build costs by about 7.7%, averaging $2.8 million growth per shack. And get this, they also improved build timelines significantly, down to between 14 and 39 weeks. That's way better than the 16 to 56 weeks before.
Yeah.
It suggests they're really getting a handle on the construction side.
Exactly. That's a huge improvement. And it's not just about the new places either. They're also strategically optimizing their existing portfolio. So reinvesting in the Shacks they already have, renovations, upgrading digital infrastructure, which is crucial, right, for keeping that consistent quality and guest experience everywhere, making sure even the older spots feel fresh and run smoothly.
And building on that, there's the accelerating their licensed business, which is, a smart way to grow without putting up all the capital themselves, an asset-light model. They finished 2024 with 250 licensed Shacks around the world. Domestically, they're doing well in airports, travel plazas. That makes sense. And here's that really cool example of brand extension, partnering with Delta Airlines. Shake Shack at 35,000 feet. I mean, think about that reach. It's pretty unique. But the report wasn't all sunshine, right? It did mention some headwinds for the international license Shack, macroeconomic, geopolitical stuff, which actually led to them closing 6 locations in 2024. So a reminder that even hot brands face global challenges.
Yes, exactly. Those closures kind of underscore the external pressures that, even really successful companies can't always sidestep. So, okay, we've talked expansion strategies, build costs. But how does all this filter down to the day-to-day, to the operations, and maybe most importantly, the actual guest experience? Because that's really the heart and soul of the Shake Shack brand, isn't it?
Totally. And that brings us right back to that core philosophy, enlightened hospitality. This really doesn't feel like just some corporate buzzword for them. It seems like the bedrock of their whole culture. It starts with genuinely caring for their own team members. The belief seems to be if you treat your employees well, they'll then go the extra mile for guests, for community, suppliers, and yeah, ultimately for the investors too. It feels truly foundational for them.
And you can see that emphasis on culture reflected in their digital evolution, too. They saw really strong growth, 20.3% in digital sales in 2024. Digital now makes up, 36.6% of their total SHAK sales? That's significant. And they're not just making ordering easier. They're investing heavily in kiosks, using them for analytics, understanding guest behavior, improving cross-selling. They even improved their mobile recruiting platform, so weaving tech into how they manage the people, too.
Yeah, good point. And it's not just digital convenience, is it? The culinary innovation is still a huge draw. They highlighted successes like the summer BBQ items, the black truffle stuff. Those limited time offers create buzz. But what I find really unique is how they actively collaborate with local chefs and artists, like the pastrami shack with Zingerman's Deli in Chicago or the Thai diner shack in New York. That really reinforces their whole identity as a warm community gathering place, not just another fast food joint.
Absolutely. Those local touches are key. And underpinning all of this, there's their focus on team development. They call it building a culture of leaders. The numbers are pretty telling, 12,826 team members. And in 2024, they promoted 3,454 people internally. Get this, 68% of new general managers and 60% of new area directors came from within. That's huge. They have programs like Shift Up for early career managers, too. And their commitment seems real, with competitive wages, benefits, even equity-based compensation for managers. It's all designed to attract and keep good people in a really tough labor market. They do acknowledge rising labor costs are a pressure point, but it sounds like an intentional investment in their people, their most valuable asset.
That give us a really comprehensive picture of the strategy, the operations, the brand philosophy. But okay, the big question, how does all this translate to the bottom line? To their financial health. Let's zoom in on those 2024 financial highlights. Let's see how it all adds up.
Right. Connecting it all to the numbers. 2024 was, without a doubt, a record year for them financially. They hit total revenue of $1.3 billion. That's a significant jump, 15.2% year-over-year growth. And system-wide sales, remember that includes all the company and licensed spots, also hit a record $1.9 billion, up 13.0%.
Okay, so drawing down a bit. SHAK sales, that's the revenue stream from their own stores, hit $1.207 billion. And same SHAK sales, that's the key metric for comparing existing store performance year over year, grew 3.6%. Now, the report says this growth was mainly driven by price increases and mix what people ordered, even though actual guest traffic dipped slightly.
Yeah.
So it was interesting. But their average weekly sales, the AWS, hit $76,000 for the year. That's the highest it's been since 2019. So existing stores are definitely pulling their weight.
They are. And that licensing revenue from those asset-light partnerships we talked about, that also grew nicely, up 10.6% to $45.0 million, mostly driven by those 27 net new licensed shacks opening up. It shows that model is definitely contributing meaningfully to the top line.
Okay, now let's talk profit. Their GAAP operating income, that's profit by standard accounting rules, was $3 million, and net income was $10.8 million. But investors often look at the non-GAAP numbers for a clearer view of ongoing operational performance, right? Stripping out some noise. So on that basis, their restaurant-level profit was $257.9 million. That's a really solid 21.4% margin. And that margin improved by 150 basis points year over year. Just to clarify, a basis point is 1/100%, so that's a 1.5 percentage point improvement. The report directly links this to those operational improvements we discussed, which is, well, very positive.
Definitely. And their adjusted EBITDA earnings before interest, taxes, depreciation, and amortization, basically a proxy for operational cash flow, that figure soared. It reached $175.6 million, which is a massive 33.2% increase year over year. The margin there was 14.0%. These stronger profit numbers, they really highlight how they're managing costs better and finding efficiencies while still growing fast. And if we look quickly at cost management, food and paper costs actually went down as a percentage of sales, mostly thanks to those menu price increases, which offset some marketing promotions and rising costs for things like beef and fries.
Right. Labor costs, as we kind of expected, did go up. Higher wages as they invest in teams. But like you said, that seems like an intentional cost tied into their strategy and that enlightened hospitality thing. Other operating expenses were also up, mainly higher transaction costs, think delivery commissions plus facilities, maintenance, and marketing spend.
Yeah, all part of growth. One notable item hitting their GAAP profitability was a big jump in impairment charges to $32.4 million. And that was mostly linked to closing 9 company-operated shacks back in August 2024. It's a big number, sure, but it also shows they're willing to make tough calls, prune the portfolio, and exit locations that aren't performing, which helps overall financial health long term.
Okay, and what about cash flow? Balance sheet strength. Where did they end the year? They finished 2024 with a pretty healthy cash balance, $320.7 million in cash and equivalents. But here's the really remarkable part, I think. A critical milestone. They generated a record $35.7 million in free cash flow. And this is the first time they've had positive free cash flow for a full year since way back in 2017. Can you maybe explain why that's such a big deal?
Absolutely. It's a huge deal. Free cash flow is basically the cash a company generates after it pays for all its operating expenses and its capital expenditures, like building all those new shacks. So getting to positive free cash flow, especially after years of heavy investment, means the business is now generating more cash than it's spending to operate and grow. It's a really strong signal of financial self-sufficiency and health. It shows that their aggressive expansion is actually becoming sustainable from a cash perspective. In terms of debt, they've got $250 million in those 0% convertible senior notes due in 2028 and a $50 million revolving credit line, but nothing was drawn on that at year end. They also have that complex financial thing, the tax receivable agreement, or TRA, a liability of $247.7 million. You can sort of think of it as a historical obligation to past shareholders linked to tax benefits the company gets from its structure. It's a real liability, and it impacts their cash flow as they make those payments.
Okay, so strong performance, record revenues, positive free cash flow finally, ambitious growth plan still in place. What does this all mean for, someone listening, an investor, or just someone curious about the brand? What are their plans for creating shareholder value, and what's the sort of long-term vibe here, balancing this growth with that premium brand feel?
Yeah, that's the key question, isn't it? How does growth translate into direct returns for shareholders? Well, the company is very explicit about this. They state they do not currently expect to pay any cash dividends. Their focus for creating shareholder value is pretty much entirely tied to the stock price going up, the appreciation of their Class A common stock, which aligns perfectly with their strategy. Keep expanding profitably, keep improving operations, and hopefully the market rewards that with a higher share price. They cite the big funding needs for continued growth, plus existing debt rules, as the main reasons for not paying dividends or doing share buybacks right now.
Right. No immediate cash back. Focuses on growth driving the stock price. Makes sense given their stage. And that TRA liability we mentioned, while complex, is a real factor in their cash flow planning as those payments get made. Looking ahead, the company definitely maintains an ambitious outlook. They sound confident about continued profitable growth and sticking to that long-term target. 1,500 plus company-operated shacks in the U.S.
Yep, and that means ongoing investments, continuing to optimize operations, driving visits through food innovation and digital channels, and, critically, building out those strong leadership teams needed to manage all that growth. But, it's always important to acknowledge the challenges and risks. They're very aware of them. The report mentions the super competitive industry, inflation still being a factor, rising labor costs, and that global volatility, macroeconomic, geopolitical, that affects their international licensed business. They also talk about ongoing efforts in cybersecurity, responsible sourcing, the stuff any big company has to manage today.
So, in essence, they're doubling down on their commitment to that stand for something good purpose, using it as a guide for decisions from ingredients to community stuff as they navigate these headwinds and push for really aggressive growth. And there you have it, our deep dive into Shake Shack. It reveals a company that's not just adding locations like crazy, but also strategically tweaking its operations, investing really heavily in its people, and using digital tools smartly to boost profitability. It's this fascinating, almost paradoxical mix, isn't it? Aggressive, fast expansion coupled with this deep commitment to their unique fine casual identity and that premium quality.
Exactly. That's what really stands out to me, too, that underlying tension, or maybe it's a synergy between scaling up massively and holding on to that enlightened hospitality philosophy and quality focus. They're basically betting big that you can scale up a more premium, fine dining inspired approach within the fast casual world without losing the brand's soul. And, the 2024 results, they suggest they're making a pretty compelling case so far.
So here's the big question, maybe, for you to think about. Given Shake Shack's strong financials now, their huge expansion plans, that constant focus on efficiency and the unique guest experience, How might they, or maybe other brands trying to scale up, continue to redefine what fast casual dining looks like in this increasingly competitive and also more conscious market? Is this model truly the blueprint for sustainable premium growth going forward? Something to chew on.